and start going over the questions. So this is the second portion of the final exam review. Let's remind you quickly what happened the previous time, what we did the previous time. What we did previous time was we went over the cash flow statement, questions 1 and 2 questions. So on the exam, what you have to do, you have to, again, you don't have to prepare the cash flows from scratch. It's going to be given to you. You just have to fill up the information on the blue cells. You're going to have information about the balance sheet. You're going to have additional information, and you're going to have information on the income statement. So you can use that information and come up with your answers. You can easily do that. Now, the next question that you're going to see is in respect to the partners and allocation of the income to the partners, how we're allocating it. If you have 1 or 2 or 3 partners, who's getting what? Don't forget, the general idea on the partnership is give the partners everything that they ask for or have it on the contract, or it's in the information of the questions. Give them everything, because don't forget this. At the end of every question, at the end of any of those partnership, you're going to have this statement: the remainder is shared equally. And remainder doesn't necessarily has to be positive. It can be negative as well. So that's why everything that's left is going to be shared 50-50. So don't be scared if you see that you might see that at some point the amount that you start allocating become the chunk amount become negative. From income, you become a negative. Don't worry, keep giving them until the end. Don't forget. One thing that I don't want you to forget is, at the end of the day, you're allocating the net income. You're always allocating the net income. So whatever the net income is in the beginning, when you combine this amount that each partner gets, it has to be equal to that net income amount. Right? That will be the crucial part here. So when you combine whatever partners get, that has to be equal to the net income that you're starting at the very beginning. Is that net income later going to convert to the negative or positive? It doesn't matter. The point is that you have to allocate the net income. Now, the next question was for the not payable. The not payable, what will be interesting with not payable? Not payable, obviously, we're going to have a reporting date within the payment date. So you're going to have a reporting date. Remember, liability is the obligation of the company at the reporting date. So every time when you have a reporting date, you have to see, and you have to ask yourself, is there anything that the company has to pay in the future for today because they did something in the past? If the answer is yes, there's a liability. Show that liability. And after that, the payment comes. On the payment, close first the payable if you want to go that one. Clear the liability that you created. Clear the liability, original liability with the notes payable. Add the remaining of the interest from the reporting date to the payment date and pay everything else in cash. The next question that we saw was the warranty and the warranty expenses. On the warranty, you always accruing the warranty expenses by adding warranty liability. Now, in this case, will be warranty liability, not estimated warranty payable, or not estimating warranty liability. It's just going to be warranty liability, I believe, in the case. So anyway, you can see it in different terminology. Once you see it, use it. So it's going to be warranty expense on one side, warranty liability on the other side. When you accruing the warranty, why do we need to agree the warranty? Because we want to match the expenses with the sales. That's the whole idea. We have sales, which sales comes with the warranty. We don't know the warranty because the warranty is extended for the next year. So over the next year, I owe the warranty. Do I know how much I have to pay? No, I don't. But can I estimate it? Yes, we can. The question is going to tell you what's the currently expected warranty, or what's the estimate for the expected warranty expense. And then they're going to show you the actual warranty. The last thing that you have to do is to show the balance on the warranty liability account. What's the balance? Is it credit? Most likely will be credit because that's a normal liability account with the normal balance credit. It might end up with the debit balance. If the warranty liability end up with the debit balance, that means that the allocation base that they're using for the warranty is not enough. They have to change it in the future, but that's beyond the scope of this course. Just I'm telling you that there might be certain instances that you may end up with the debit balance. That's not the end of the world because there's a next period coming. So you don't have to worry about it. And once you become accountant with that. So those are the questions that we covered last time. So now we have to move to the next one. Next set of questions that I have for you today. And let's start one after another. Now for this set of questions, we're going to start question 1 and keep going until we finish it. I have 6 questions for you today. Let me see if you see my screen. Now you definitely should be able to see my screen.
Yes.
Okay, so in January 13, 2022, this company purchased shares, store fixtures for $65,000 cash, expecting the fixture to remain in service for 10 years. Company has amortized the fixtures on the double declining balance basis with estimated residual value of $5,000. On September 30, 2023, the company sold the fixtures for $19,150 cash because they were not environmental friendly. What we have to do, we have to record the amortization expenses on the fixtures for the year end December 31st, 2022 and 2023 up to the date that we sell it, and we have to record the sale of the fixture on September 30th, 2023. That's what we have to do. So in this case, in this type of questions, what we have to do is very simple. Just give me a second here. I need to do some adjustments here quickly. I want to stay with the questions so I can make sure that you're going to see exactly what I'm seeing, and there will be no confusions when you're doing this type of questions. So for that reason, just give me a second here, and I'll be right with you. This is question from, as you can see, this will be question from chapter 10, obviously, since we're talking about the long-term assets. me find something similar to this, and we're gonna continue with this. All right. So once you're approaching those questions, what you have to do is first, we're dealing with assets, correct? So you can easily calculate the original cost of the asset. In this case, original cost, it's obviously how much is it. Let me make those bigger so you can see them. Original cost of this asset is $65,000. That's our starting point. Then we're going to have the residual value, which in our case is $5,000. So technically, over the life of these assets, of this particular asset, those fixtures, we have to amortize $60,000. That's out of the question. So we have the starting point. Now we have the expected years in service. We have 10 years. And the method that we're using is double declining method, double declining balance method. So if we have the double declining method, first, before we go to the double declining method, we have to calculate what's the original percentage for the amortization in this case. So how we getting the percentage? We're getting 1, that will be 1 divided by years of expected year in service. So our normal percentage for the amortization will be 10%. If we have to double it, double declining is time 2. So now percentage for the double declining will be 20%. So the first year, we can easily calculate that one. What's going to happen in year 1 and what's going to happen in year 2. In year 1, our beginning balance will be $65,000. Our amortization expense will be 20% of that amount, 65 times 20%. And our accumulated amortization in this case will be only 13,000. And our residual or ending balance, in this case, ending balance will be beginning balance minus the amortization expense, current amortization expense. So the second year, we're going to start with the 52,000. And if we have a full year, then we're going to apply the 20%. So let's pretend that we have a full year, even though we purchased it in 2022 and we sold it 2023. So we use it 2022 for full year. 2023, we start using it. So let's pretend we're using it for the whole year. If we're using for the whole year, our amortization will be 20% of 52,000, correct? will be 10,400. Then accumulated amortization is going to be this one number plus the amortization of that period, and my ending balance is going to be that balance minus the amortization expense will be 41,600 if we have a full year. So from here, what we can take is, first requirement is record amortization expense of December 31st, 2022. So let's do that journal entry. Once we have this, what will be the journal entry here? Debit. Which account we're going to debit? Come on, people.
Amortization expense?
Yeah. Amortization expense for the amount of, we already calculated $13,000.
Yeah.
Right? Which account we're going to create?
Accumulated.
Amortization. Yeah, we already have it. Credit will be, let's put it here, but let's go here. Credit accumulated amortization.
452,000.
Why 452,000? Debit and
No,
credit has to be equal,
sorry,
right?
13,000.
13,000. Debit and credit has to be equal.
Yeah.
We cannot do anything else. So that will be exactly the same amount. And we're done with the first one. That will be on the December 31st, 2022. That will be our entry for that date. Next thing, we have to record the amortization, record amortization expense of the fixture at the end of 2023. No, for 2023, not at the end of the 2023, for the 2023. So let's do this amortization expense for 2023. Now the question is, in 2023, when we're selling the assets, we sold the asset on September 30th, right? This is the day that we're selling the asset. Remember? On the September 30th, we're selling the asset. Asset is gone. Do we have the full year?
No.
No. So what we have to do? We're gonna get the amortization for the whole year. So if we're using this calculation, I'm gonna copy it and paste it here, but I'm gonna paste it as values. So we have those values here, which is if I have to get the beginning stuff, so we can see the numbers. I have those beginning balance, amortization expense, accumulated amortization. Again, this is for the entire year. So how much is per month? Can we calculate it per month?
Yeah.
Well, yes. Amortization expense per month.
867. If you want
10,400 divided by
12.
Divided by 12. Right? Once we have this number, so let me see in the questions how it's going to be given to question. So on every question, you're going to have these things. The question is going to tell you this. Let's make it bigger so you can see it. Record debit first, then credits. Exclude explanation of the journal entry, so you don't have to provide explanation of the journal entry. And around your final, so if you have to do your final number around your final answer, to the nearest whole door. amount. So can I leave it like this?
No.
No. So let's go to the journal entry now. What will be my journal entry here?
Debit cash.
Hmm?
Debit cash.
Why would be debit cash?
Why not we get money? Or we have to amortization first and then
I
we're
have
gonna
to do the amortization first, and then I'm gonna
Okay.
get the money, right? Because I want to see how much will be my accumulated amortization up to this point. Make sense? So I
Yeah.
need this amount here. So first I'm gonna do the amortization. I'm gonna do exactly the same entry here. The only difference will be the date. Instead of December 31st, I'm gonna have here September. So that will be 30th 09. Let's see if this is gonna work. Actually, why I'm worried about this when I can just go here and change that one to 9 months. That will be September 30th and 2023. That will be a way easier. So amortization expense for that particular year is gonna be equal to, let's round this number.
867.
Right. Round this number, comma 0, rounded. 867, and I have my amortization expense for that particular year. So now, once I have this amortization expense, is that for one, but this is for 1 month, right? How many months I have from January
Yeah.
1st to September?
Nine.
9. So can I leave it like this? If you leave it like this, you're gonna make a mistake.
No.
So what do we have to do? Put a bracket inside this amount time, 9 months,
9.
and put the brackets. And now we're gonna have our amortization expense. So now I have, so this now it's not 10,000 anymore. So what's happened with my schedule? Now my schedule is not longer this. My schedule, I have to change my schedule. And my schedule in this case will be amortization, original value will be, no, I don't want to do this. I'm gonna paste it like a numbers. So I can have everything the way I want it to have it. And I'm gonna put those dollar amounts here. So my amortization expense first year is 13,000, accumulated 13,000, and in balance I can copy those formulas here. Those formulas, they're not going to change. Okay, second year half of starting 52. Here my amortization expense is not 10,000 anymore, it's only 7,800. So how much is my accumulated amortization? 20,800. Make sense? So now I can do the journal entry to record the payments that I received. So let me see the requirements here. What do we have to do? The last thing that we have to do is record the sale of the asset. Let's get rid of this. So we have to record the sale of the fixture on September 30th, 2023. So let's start doing this journal entry. Now you can jump and Elena and tell me which account I'm going to debit now.
Cash.
Get the cash. First thing, so when you see something selling of assets, first thing that I want you to do is get the easiest one, starting with the cash. Get the cash. If you get in cash, if you know the amount of the cash, just get that cash, 19,150. We got the cash. Why are we getting the cash? Now start asking yourself logical questions. Why am I getting cash? Because I'm selling fixtures. Well, did these fixtures come with the original cost? They came with the original cost. What was the original cost? 65,000. So if I sell those fixtures, do I have those fixtures with me anymore?
No.
No. So what do I have to do? I have to get rid of them. Get it out of my balance sheet. So how can I get them out? Credit fixtures. And what was the original cost? 65,000. Get rid of this 65,000. So now I don't have fixtures, but I have this tricky account accumulated amortization, which is contra account to the fixtures. Also is companion account to the fixtures. If I don't have a fixtures, can I have the accumulated amortization fixtures? Can I carry that account with me?
No.
No. Do I know my accumulated amortization until the point of sale?
Yes.
Yes, let's get rid of that. Debit, accumulated amortization of the fixtures. And that will be equal to 20,800. So what do I have to do? Now I have to check where is my credit, where is my debit. My debit is 39,950. So I'm way below my credit. So what do I need? I need another debit. Which account I'm gonna debit?
Loss.
Loss. On what? On? Why I'm losing money?
Sale of fixtures.
Sales of fixtures. Okay, and that loss will be equal to 65 minus 19,150 minus 20,800, and we're done. That's what you have to do for this question. Now, the tricky part here is obviously you to understand that you're using double declining method first. Double declining method doesn't calculate the amortization based on the amortizable amount, but based on the original cost. You're applying the original cost, you're coming up with the amortization for the first year. Then on the year that you're disposing the asset, you're showing the accumulation of the amortization for that portion of the year only. Get the monthly, so calculate on the normal for the normal year, divided by 12 to get the portion for month. Calculate how many months you're using the assets. Stop the amortization at that point. Then what you have to do? Record that amortization for the partial year until the date of sale. And after that, get rid of the asset, get rid of the accumulated amortization, get the cash, balance the entry. Either debit, either credit, whatever you have. What's going to determine is it loss or gain? The cash that you're getting. And that's your question for the amortization for chapter 10. Any questions on this one?
No question.
Sorry?
No question.
No questions or yes questions? Okay. Let's go with the next one. Next question will be a little bit more heavier. That's coming from chapter 15, which comes on long-term debt. Now, on the long-term debt, you're going to have this table. You're going to have the information available for you. I purposely copied the requirement so you can see that you have to round your answer. Let me see if I can add here a line, or I get this one here. I'm gonna get rid of this. Paste it here. So what you have to do, you have to round your answer to the nearest whole dollar amount. Now, before we do this, start with this question, what we can see. On September 20th, 2023, when the market interest rate is 6%, this company issue $8 million, 8%, 20,000 bonds for 9,849,182. So you don't even have to calculate the amount of cash that you're getting. Now the bonds pay interest on March 31st and September 30th. This company amortizes the bonds premium by the effective interest method. What that means, effective interest method? That means that they applying the interest expense based on the outstanding amount time the percentage, the interest rate on the market, not on the bonds. So first we have to prepare amortization table for the first 4 semi-annual interest periods, in which this company amortized the bonds premium by the effective interest method and record the issuance of the bonds on September 30th, accrue interest December 31st, 2023, and semi-annual payments on March 31st, 2024. So we have to record the first 3 transactions on the life of those bonds. Once you see this information, what you have to shop? You have to shop for some additional information so you can see, is this make sense? So let's think about it. Market pays 6%, we're paying 8%. Is it make sense we to sell our bonds on premium? Are we above the market or below the market?
Above.
Above. So once we are above the market, our bonds are attractive. So people are willing to pay premium. Make sense? So the whole idea makes sense. We're getting more cash. Now the question here is, we have to fill this on the issuance date. Obviously, the schedule here, that schedule is going to be given to you. So you don't even have to worry, is it discount or is it premium? It's going to be given right directly to you. If it's premium, says premium. If it's discount, it's going to say discount. In this case, we have premium or discount? Premium. How much is our premium? Well, let's see first. Forget about the premium. How much cash we get? Can you see how much cash we get?
$9,849,182.
182. Thank you. We get this amount. So the question is, how much is my premium? Well, that amount minus the
$8 million.
stated value on the bonds, 8 million. 1, 2, 3, or the book value of the bonds, 2, 3. My premium exactly 1,849,182. So let's go. I have to pay interest, right? How much interest I'm gonna pay? Since I'm paying twice the interest. So every time I'm gonna pay 4% interest. Make sense? You know what? Forget about this. Let's go with this. What's the value of the bond? 8 million, right? Make sense? Are you guys with me?
Yes.
Bond is 8 million. What's the interest that the bond pays?
%8.
8%. I'm gonna move this one right here because I want to put those percentages. We're paying 8%. How many times we paying? So how much will be the payments, interest payments? So actually, I don't need to move it. Let's go with this. Let's go back here. Interest payment. Interest on the bonds pay. Interest. How much will be my interest payment? Annual interest payment in this case. And that will be 8 million times 8%, correct? $640,000. How many times I'm gonna pay the interest?
Twice in a year.
Payments of interest
40?
per no payment. So what will be that? Interest per payment or interest payments? No, interest payments. That will be the total interest. Let's go. Total annual interest expense. Let's make it correct terminology. Otherwise, I don't want to lose you and you to start wondering what's going on here. So the total annual interest expense times of interest payments. We're paying them 2 times. And amount per interest payment will be this one divided by 2, correct?
Yeah.
Okay, let's keep going. What else do we need? Market interest rate. How much my market interest rate? 6%, correct?
Mhm.
But time of interest payments is 2. So market interest per payment, it's gonna be
Okay.
6 divided by 2. Or it's gonna be 3%. Okay, so what do we need to calculate? Let's pretend that we don't have the present value. We have to get the present value of the bonds. What do I need? That will be my future value, correct? The 8 million or the book value of the bond, that will be my future value. Are you guys with me?
Yes.
Payment of the interest, that will be my PMT. Market rate will be my I and Y. The last thing that I need is the number of the payment periods, right? So let's add some more lines here. And let's get rid of this line here. The last thing that we need is the payment periods. Or years on bonds. How many years we have them? For 20 years, correct? That will be 20 years here. And how many payments? So payment periods over the life of the bonds, that will be 20 times number of the payment that we're gonna pay. We're gonna pay the payments 2 times, so that will be 40. 40 payments period, that will be our end. Now I can chase my present value. So how are we gonna get the present value? We're gonna go to the formula, or we're gonna go to the financials. We're gonna go to the present value, and on the present value, our rate is 3%. Periods, 40 periods. Payment, 320,000, but since we're paying it, that will be negative in our, since it's cash outflow for us. Future value, also outflow for us. The question is, how much is the present value of the bonds? And we're paying in the beginning, so we can avoid this one or ignore this one, and that will be our present value right here. Most likely that present value have to match the question, and exactly matching the question. So we know from where the present value comes from. So now I know my premium is correct, my present value is correct. So payment, how much I have to pay? Every time when the payment comes, I have to do this payment, right? Let's highlight those one, the one that we need for our calculation. So how much will be my interest payment? What you gonna say?
320,000?
320,000. How this payment's gonna change?
It's not.
It's not, so I can copy it and paste it all the way to the end. Not like that. Let's paste it as a value. Why doesn't give me option? Control C and paste as a value 320,000. Now, interest expense. How am I going to calculate the interest expense? What's the balance outstanding?
9,849,000.
So that one time,
3%.
that percent is even given to you.
Okay.
That will be given to you here. So you don't have to sweat on it. It's going to be equal to this time, this amount time, 3%. Anyway, we have it in our formula, so we can easily get it. So now we're going to have the difference, correct? So what do we have to do? No, that difference, it's got to be a round amount. So let's go back to the round amount. So in this case, what will be the difference? Will be this amount minus that amount. The formula is given on the top of the cells for you. Make sense? And we still have to round it to the nearest dollar amount. So let's round it to the nearest dollar amount. Now, what we're going to do with unamortized premium account on the bonds? How are we going to get this? We're going to get the original amount minus premium amortization, correct? And we're going to get this amount. And what will be now new carrying amount? It's going to be beginning balance minus premium amortization, correct? Are you guys with me?
Yeah.
Okay. What's our objective at the end? At the very end, if we have to do calculation here, check. If you have to do the checkpoint, what's our objective? This amount minus that amount to be equal to the $8 million. Once you get a $10 million, that means you're in the right spot. So what's the bottom line? What's the after 40 payments, where I expect this amount here to be? If I fast forward on the 20 payments, which we're not going to do right now, right? Don't get me wrong. We're not going to calculating now 20 payments from now. But if we have to calculate those 20 payments from now, what will be my ending balance on the bond carrying amount? It's going to be the same like a original bond amount, correct?
Yeah.
So I have to reduce this amount, 9,849,000, all the way down to $8 million. That will be my objective. How much will be my premium at the very end of my calculation?
0.
0. That's my objective. So what that means, that every time when we have interest payment, I have to start reducing the premium and I have to start reducing the carrying amount of the bonds to bring down the premium to 0 and to bring down this amount to 8 million. How much will be my premium amortization total at the end? It's going to be equal to the original amount, correct? That's how much I'm going to amortize over the life of those bonds. Okay, so next period. We get the first period. What I'm going to do the next period? Same idea. Beginning balance time. Those 3%. Once I get that amount, what's the next for me? Are you guys with me?
Yeah.
So what's the next for me? Well, I just can copy the paste the formula, right? Once this is calculation as well, I can copy paste the formula. This is also calculation for me. I don't have to sweat on that thing. I can easily move it down. And let's see where my check is. Am I on the right spot? Yes, $8 million. Next period. Again, carry amount, time, 3%. And all those formulas will be the same. Next period. Let's see if my check is correct. Yes, I'm at 8 million. Next period. What I'm going to do? The carrying amount time 3%. Carry the formula. Boom, done. Your calculation is done. Now what we have to do now? Once we prepare this amortization table, the next thing that we have to do is to record the issuance of the bonds on September 30th. So let's do the September 30th first. September 30th. What's happened on September 30th? What we get? Why are we issuing bonds? What we chasing? Come on, people.
Cash.
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 That's the only reason that we're issuing the bonds. We want cash. How much cash we get? This amount or that amount, whatever amount you want, is the same amount. It's not going to change. So let's round it. Okay. Why we get the cash? Because we issue bonds, right? So now we have to put credit bonds. Bonds what?
Payable.
Payable. Credit bonds payable for $8 million. And since we're not in balance, we have to add more. What will be the more that we're going to add?
Premium on bonds payable.
Credit premium on bonds payable. And the premium is going to be simply either this amount, either you get it as a calculation of those two amounts. It doesn't matter. It's always going to be the same. Minus 8 million. And it's going to be the premium. Don't forget to round it. to the nearest dollar amount in order to get the right answer. So we get the September 30th. The next thing that we have to do is the accrual of the interest December 31st. So now December 31st comes. 31st comes. How many months we have from September 30th to December 31st?
3.
3 months. So for how many months is this interest that we pay? If you pay twice a year, how many months we pay interest?
6.
For 6 months. So if we have 3 months only outstanding, that's right in the middle, correct? Make sense?
Yes.
Yeah.
So let's pretend those dates here are kind of awkward. So 2023, first payment is March 30. That should be, no, 24, that's 24. Yeah, that's correct. 24. So let's pretend for a second, let's keep the December and let's go to March 24th. 31st, 2024. Let's do this entry. What we have to do on March? Let's pretend that there's no reporting date. No reporting date. March 31st. Give me the journal entry for the March 31st.
Debit interest expense.
Debit, interest. Do I know my interest expense? It's right here, right? I know it. How am I going to pay? What do I have to pay to my bondholders?
Huh?
Cash. Yes, we have to pay them cash. How much cash do we have to pay them?
320.
320,000. Let's pay them 320,000. And the difference, where the difference is going to go?
To debit
Debit, what we're going to debit?
interest payable.
Premium on
What?
bonds payable.
Premium
Yeah.
on bonds. Let's
Mm.
debit premium on bonds because we created that premium on bonds. Now we have to reduce it down to 0, right? So let's do debit premium on bonds payable for the minus that one. Okay. Or I can directly get it, that amount, I can get it directly from here. Since I have it calculated for me, I don't have to worry about it. So we have our journal entry. It's balanced, everything is perfect. But from here up to here, we have a middleman, which is right in the middle. So what we have to do? We have to split those interest expense. So I have to repeat those two. And since I'm not paying cash on December, there's no cash payment. I have to show my liability, correct?
Interest payable.
Interest payable. And that will be my credit, which I have to add now in the middle. So once I add that one in the middle, that means I need one more entry here. Whatever I'm creating here, I have to get rid of it. Debit interest payable. And I'm going to get rid of it. Now, this is my original amount. Those are my original amount. And this one here. But obviously, now I'm going to have to do some adjustments. Why do you have to do the adjustments? Because I have a mid payment here. What I'm going to do, I'm going to get this amount. I'm going to divide it by 2. Make sense? Because from September to March, I have exactly 6 months. And December is right on the middle. Either you get it this amount divided by 6 times 3, either this amount divided by 2. Either way, it's going to work. Make sense? Do you understand this?
Yeah.
Okay. So let's get those 2 and let's work with them. So my interest expense here will be this amount divided by 2. Or you can get it divided by 6 times 3. It's going to be the same calculation. It's up to you. And then I'm going to get the premium amortization. That will going to be the premium divided by 2. And the same formatting because we want this to be rounded. And now I have my interest payable, which is equal to this amount plus that amount. What I'm going to do later, I'm going to get rid of the interest payable first. And what I'm going to add here, the remaining of this amount. I'm going to have, this is my original amount minus the interest expense that I show on December 31st. And here I'm going to have the original amount minus the bond premium that I have in the beginning. So from where I'm getting those amounts, I'm getting it right from here. This one will be equal to this one, and this one is going to be equal to that one. And that's how you balance your journal entry. Now, are we in balance? That's 320, 320, 160, 160. So the question is, do we have total interest expense from those 2 entries here? This interest expense and this interest expense, do they give us total of that amount? Obviously, they should. And this bond premium and this bond premium is the total of this amount. With the rounding, it is this amount. So technically, what we're doing is we're getting the interest payment and split it by half, by 2 entries. One for December, the next one is to the March. And the same thing we're doing with the premium on the bonds. And once we get those 2, in December, we're showing interest payable. On the payment date, we're closing the interest payable. And we're adding the remaining the interest expense and the remaining bonds payable to balance the entry. Questions? Do you understand this logic?
Yeah.
Okay. Let's move to the next question then. Next question, it's even easier. Let's do this question. This is from chapter. Let's see which chapter will be. This company completed the following investment transactions for 2023. Oh, that's investment. That's chapter 16. So they purchased 2,000 McGill Corporation common share for 60,000. Reyes planned to sell the shares in the nearest future to meet its operating cash flow requirements. Broker commission on the purchase was $800. Then they received a quarterly cash dividend of $1.50 per share. The next thing that happened is the current fair value of the common shares is $62,000. This is at the year end. And the last thing that happened, they sold the shares for $64,000 less the brokerage commission on the sales of $900. What do we have to do? We have to make the entry to record the investment transactions, and we have to show how would be report the investment on the corporate shares on the balance sheet of on the December 31st, 2023. That's what we have to do with this question. So again, obviously this question is from chapter 16. So let me see exactly where we're going with this question. Just give me a second. So it can be very close to what you're gonna see. Since we have to record the journal entries and we have to show the just give me a second to find something similar here. Trying to find something which is very similar to what you're seeing here as a question. So there will be no surprises. Okay, I found something similar. So let's start with our question. First thing, on November 6th, what we get?
Common shares.
We purchase shares. How are we gonna show that purchase on our balance sheet?
Short-term investments.
Short-term investments. Short-term investments. Why? Because the management says that they're going to sell it in the near future. So we'll be short. Short-term investment. And that short-term investment is going to be for, that will be debit, obviously. Debit short-term investment. And we're going to debit for amount of 2,000 shares time. Actually, it's going to give it to us 60,000 directly, 600,000, correct?
Yes.
We don't have to calculate the price per share, 60,000 directly. Now, what else are we going to pay?
Brokerage.
Commission.
Brokerage
expense.
fees. That will be the expense. Brokerage expense, that expense will be for $800. And this investment is going to cost us credit cash for the same amount, correct? This one plus that one. And we're done with this. Make sense?
Yes.
Now the next thing, what's the next thing that's coming? We received a quarterly dividend, $1.50. Let's get that dividend. When are we going to get the dividend? On November 30th. November 30th. So November 30th, let me see, is there any specific requirements on this question? No, there's no rounding, nothing like that. It doesn't say anything about rounding. At least I don't see anything about rounding. No, actually. So it says here, record the debit first, then create, exclude explanation. So you don't have to provide explanation on those ones. That's even easier for you. You don't have to provide any explanation. So we're getting the dividend. What are we going to get?
Debit cash.
Debit cash. And how much cash we're going to get? 1.5 per share, right? How many shares we get?
2,000.
2,000 times 1.5 per share. Oops, that's not what I want. That should be this one. $3,000. Credit.
Dividend revenue.
Dividend revenue. For the same amount, correct? Now December 31st comes. What's going to happen on December 31st? We have to bring our investment to the fair market value, correct? Where is the fair market value? Is it the amount that we're having in our investment or more?
62,000.
62,000. So our investment currently is sitting on the 60,000. So we have to add something. What are we going to add? Debit. Which account we're going to use? Now you don't have to remember this account because this account will going to be given to you. But account is called Fair Value Valuation Allowance. Make sense? So
Yeah.
in this case, you're going to debit Fair Value Valuation Allowance account. How much?
2,000.
2,000. And which account I'm going to create now?
Unrealized gain.
Unrealized gain on what?
On fair value adjustment.
On the fair value adjustments. That's correct. That will be unrealized gain on the fair value adjustment for the same amount, correct? Just to keep the entry in balance. The last thing that happened is they're selling the share for $64,000, less the brokerage commission of $900. So on when they're selling on January 20th. January 20th. Now, before we get the cash, let's see. Okay, they getting cash, right? Debit will be cash. What they have to pay?
Commission expense.
Commissions. So that will be debit, correct? And that commission expense we have to pay $900. Every time when you're making money, somebody also making money. Huh? That's the fairness of the game. You're making money, somebody else is making money. You're not alone. So why we make those money? Because we sold our short-term investment, correct?
Yes.
Let's get rid of that short-term investment. Debit, credit, short-term investment. Second, because I pressed the wrong button here. Short-term investment, and that short-term investment originally at 60,000. For those of you who's going to continue accounting, you're going to see when you move to the intermediate financial reporting, that's a way more easier. We don't have to do with this fair value valuation allowance account. So now, I don't have the investment. Can I keep this account with me?
No.
No, I have to get rid of that account. So let's get rid of that account as well. Credit. And doesn't let me now, so, but we're gonna trick them. Let's get rid of this account, fair value valuation. How much is the current balance? Is 2,000. Let's get rid of that. 2,000 on the credit side. We're gonna bring the balance to 0. And at this point, we have to balance the journal entry. But the question is, did we get how much cash we get? Did we get more or less?
Less because we paid commission.
We pay commission, but the question is, did we get more than our carrying value of the investment? Our carrying value of the investment is 62. Did we get more than 62 or less than 62?
More.
More. So if we get more, we're gonna need more. So those two have to be 62. So our cash will be 63. No, those two should be 64, correct? 64. 900 we pay here, so we end up with 63. 100, correct?
Yeah.
That will be 64 here. But on this side we have 62. So what we're gonna have? We need credit. I need more credit.
Gain on sale.
On what?
Short-term investment.
On sale of short-term investment. Don't forget this. Always try to be explicit because, okay, here you're going to have the journal entry given. That's not a big deal. But in CPA, you have to come up with this by yourself. So always add more information, Only create gain on sale, that's not enough. Why I'm getting that gain? Because I'm selling what I'm selling, short-term investment. And that will be your journal entry on that one. That's what is required for you here. Now, the question here is, what will be my balance? The show the reporting investment shares on balance on December 31st. What will be my balance on December 31st of my short-term investment? What you gonna say on December 31st? My balance should be equal to the fair market value balance. Correct? What's the fair market value? On December 31st?
62,000.
62,000. So what should be my balance here? 62,000. Is it 62,000 in fact? Yes, it is. I have 60 original plus fair value valuation allowance, 2,000 on the debit side, and increase my balance on my investment to $62,000. So this will be your answer for the what's sitting on the balance sheet. Make sense?
Yep.
Let's move to the next question then. Next question will be a way more easier than this one. In this case, we're gonna pay 12,000 to acquire 40% investment of this company, assuming that this company reported net income of that much for the first year and declare paid cash dividend of $650,000. Record the following entries on the general journal. On January 2nd, purchase of the investment. Disregard any brokerage commission on the purchase. December 31st, proportionate of the net income, and December 31st, receipt of the cash dividend. So let's start here. January 2nd, what will be our journal entry?
Investment.
Investment. In this case, let me see, is there going to be any specifically says, is it short-term or long-term? What exactly is? Just give me a second. I can see if I can quickly find something like this. No, it doesn't say. It's just going to tell you that investment in some company shares. Investment, something. So how much is our investment? How much we paid? 12 million, right? That's a huge investment. And how we pay for that one?
Cash.
Cash.
Cash. And we get our investment. Let's go with the next entry, December 31st. What's happened on December 31st? We have to show the net income of the other company. So if we have 40%, which reporting method we should use? Cost method for the recording, cost method or equity method?
Equity.
Equity method. Is that clear for everybody?
Yeah.
Yes, no?
Yeah.
If you purchase more than 20% of the shares of the shares of the company, you consider to have a significant influence. If you have significant influence, you have to use the equity method. If you purchase shares, just the number of shares without saying the percentage, you're assuming that you don't have significant influence. Basically, you're going to trade it for the short term period, and then you're going to apply the cost method. So now, since we have that one, what that means? That means when the company reports the other company that we already have investment in the other company, when they report net income, part of their net income is our income. How much to be exact? 40%. So here that will be debit. Don't forget here debit, investment. Here, what we're gonna debit now?
Debit investment.
Investment of such thing. How much? That will be equal 1780,123 times 40%, 0.4. So 712,000, our investment is gonna go up. Credit. Which account we're gonna? Sorry?
Equity method investment revenue.
Equity method investment revenue. Even I cannot say it better than this. So the only tricky part here is you have to enter explanation on this question, but the explanation probably is going to be given to you as something that you have to enter. So you have to choose the right thing to enter for the explanation. And that will be the same amount. Last thing that left is on December 31st, you're going to be asked to do let's get the cash. Debit.
Cash.
Cash. How much cash we're going to get? How much total dividend they declare?
$650,000.
50.
Can we get the entire 650?
40%.
Only 40%. Sounds tempting to get everything, but we don't know 600% of that company. So we can get only 40% of that amount. Times 0.4. So we're going to get 260. So once we get the 260, now which account we're going to create?
Investment.
Investment. And such a company with the same amount. So let's do one T account and let's see what's happened with our investment. We have beginning balance, we have ending balance. Beginning balance was 0, obviously. And then we purchase something and then we have ending balance. Right? So that will be our investment. Let's make it a little bit wider. Those a little bit shorter here. And those two together. Beginning balance was 0. The January 1st. Then we purchased this investment for $12 million. That will be our debit. That will be our credit. Then we get more investment from the dividend. We get 712. And then, sorry, that's not for dividend, that's for the income. And from the dividend that we receive, we're going to reduce our investment for that amount. So where is our ending balance? Ending balance will be beginning balance plus purchase plus income minus dividend received, and that will be our ending balance at December 31st for our investment using the equity method. Make sense? I don't think the question is going to ask you that further, but if for some reason that's a question asked you, now you know how to answer that one. So that will be the two questions that you're going to see from chapter 16, investments. Let's move to the next set of questions, which will be, this company has that many shares. $37,000 of $3 cumulative preferred share outstanding, as well as 55 common shares. There are no dividends in arrears on the preferred shares. The following transactions were reported during 2023. First, declare the required dividend on the preferred shares and 0.36 cents per share dividend on the common shares. On May 14th, the date of record of the dividend declared on May 1st. May 28th, they pay the dividend declared on May 1st. And May 31st, they close the income summary account into the net income for the year. Net income for the year was $112,500. First, what we have to do, we have to prepare the journal entry to record the above transactions, which no explanation are required. Now, for the second one, assuming that the balance on the retained earnings on June 1st, 2022 was $62,000, determine the balance of the account on May 31st, 2023. So let's go first, May 1st. What's going to happen on May 1st? Is there any entry that we have to show on May 1st? Remember, for the shares, we have 3 dates: declaration date, date of the records, and payment date. So now we're on the declaration date. Do we have to do anything on the declaration date?
No.
Why not? Why not? What kind of dividend we're going to pay? What dividend is this? If we're paying it, what dividend is? Is it a stock dividend? Is it cash dividend? Talk to me, people. We have to pay them. What are we going to pay them? Stocks? Are we going to give them stocks, or are we going to give them cash?
We're gonna give him stocks.
Why we go? Where the question says that we're giving them stock dividend? Is there any clues on the questions that lead you to the idea that you're going to give them stock dividend? Do you see anywhere in the questions clues that we're going to give them stock dividend? On the payment date says we pay dividend. It doesn't say we distributed dividend or we distributed shares. Make sense? So in that case, if that's the question, that means we're giving them cash dividend. And what's the rules for the cash dividend? On the declaration date, we have to, not only the cash, even in the stock dividend, on the declaration date, we have to show the liability. On the cash dividend, we have to show the liability. On the stock dividend, we have to show something else. So let's go. Who's getting what? We have preferred shares and we have common shares. Debit.
Retain earnings.
Retain earnings. I agree with you. Retained earnings amount we're going to determine later. Credit.
Dividends payable.
Dividend payable. Preferred shares. How much will be that? Let's pay them what they want. They have 37,500 and we're paying them $3 per shares, right?
Yeah.
12,500. What's the next one? Do we have to pay dividend on the common shares?
Yeah.
Yes.
Yes, let's go dividend payable on the common shares. I'm going to change this P instead of P, going to be C, common shares. How much are we going to pay the common shares? We have 55,000 time
36.
0.36, right? We're going to pay $19,800 per common shares. So in total, how much dividend we have to pay? Are we going to take from the retained earnings? Plus that one is going to be exactly $132,300. And we cover May 1st. Now let's go date of records, May 14th. Is there going to be journal entry on May 14th?
No.
entry.
Now that will be no entry. Don't forget to put no entry, otherwise the question is not going to give you the marks. Next one, let's pay the dividend. How much we're going to pay? What we're going to pay first? We're going to pay these payables, right? How are we going to pay the payables? Cash. There's no other way. So let's go May 28th. May 28th might be a very important date for me. That will be exactly 8 weeks since the accident. So maybe I can try walking on the May 28th, but we might have to wait and see. So let's go to May 28th. So what we're going to do, we're going to close this debit dividend payable. Let's copy those one and going to change only the debit on the beginning. Debit dividend payable and debit dividend payable common shares, and we're going to credit cash. And we're going to create exactly the same amounts that we have here. And we're going to pay those payables. This one plus that one. And we're done with this. Now, the last thing that we have to do is to close the income summary account. Net income for the year was 112,500. So tell me, how can I close the income summary account?
Debit net income. Or
May-
income summary.
May 31st, debit. Income summary. Credit,
Retain earnings.
retain. For the same amount, right? And the amount is 112,500. And here we're going to have exactly the same amount. The last thing left is to reconcile. Let me make it quick. I'm going to get this investment account. I'm going to make some adjust .t account here. I'm going to put it here. The only thing that's not investment anymore. That's where we retain earnings. And what else is interesting in retained earnings? That's equity account, correct? Normal balance here are credit. So beginning balance will be on this side. And ending balance also is going to be, should be in the credit side. Otherwise, company is in trouble. Okay, let's see what's happened now. What's coming in this account? Usually, what's coming in the retained earnings? What increasing the retained earnings?
Revenue?
Net income, right? Not the revenue. Revenue, it's a good starting point, but we need something solid, which is the net income. Once we have net income, then that account will going to increase. So that will be the net income. And what's going to reduce this account? Opposite. What's the opposite of the net income?
Net loss?
Net loss. And what else? From where we get the dividend? From which account we get the dividend? From the retained earnings, correct? So dividend also is going to reduce the retained earnings. So we have the beginning balance 62,000. That's 42. Let's make it 62. 1, 2, 3. That's our beginning balance. What else happened? First, we show this on the dividend. We reduce the account with that much. Then we show from the income summary. We show that we have that amount that's coming into the retained earnings. So where is our retained earnings at the end of the period? Will be this one plus that one minus that one, and our retained earnings is going to be 42,200 ending balance. Make sense?
Yeah.
Okay. Last question that I have for you. Last question, still dealing with the shares. So this company journalized the following transaction. This company, which is conducted during 2023, February 7th, issue 10,000 common shares for $15 per share. Let's go, one after another. Why are we issuing shares? What do we want?
Cash.
Cash. So then go February 07. So that will be debit cash. How much cash we're gonna get? That will be 10,000. That will be equal to 10,000 times $15 per share. We're gonna get $150,000. Debit, credit will be common shares. Same amount. Next journal entry. On April 08. What's happened on April 8? We purchased 2,500 common shares of $13 per share. Now the average issue price per share at this point is $14. So you don't have to calculate, you don't have to do anything with the average issue price. That's already given to you. But are we purchasing above the issue price or below the issue price?
Below.
Below. So let's get the what we purchasing. Debit, common shares. And how much those common shares are on our books? We have 2,000 and 500. 1,500 times $14 per share. Is that how much cash we pay?
No.
No. How much cash we pay? We're paying 2,500 times $14 per share. So we have a difference on the credit side. So I have to create something. Which account I'm gonna create?
Contributed surplus.
Contributed. Sir. Common shares, right? That will be my balancing account. Here will be 35 minus, that will be 2,500. And with that. So next one. We're going June 02nd, right? What's happened on June 2nd? We're still getting common shares, but now we're paying $18. Our issue price is still 14. So let's get these common shares. And we're gonna get 2,000 times $14 per share. Those shares that we're purchasing back, and the book value is $28,000. Now, how much cash we're gonna pay? Way more, correct? We're gonna pay for 2,000. We're gonna pay them $18 per share. We pay 36,000. So I need, in this case, I need debits, right? Which account I'm gonna debit?
Contributed surplus, common share.
Debit, contributed surplus, common shares. Let's get rid of that contributed surplus first. Is that solve my problem?
No.
No.
No. I need more, right? How much I need more? A lot. So which account I'm gonna debit now?
Retained earnings.
Retained earnings.
Retained earnings. And that will be this amount minus this amount and minus that amount. And now we have our entry in balance. Make sense?
Yes.
All right. Questions now? Those were the questions that I want to cover with you. And once I cover those questions, I'm kind of have a comfort that I wanted. Now I told you everything that I wanted to tell you. So at this point, what I'm gonna do is I'm gonna save those ones and I'm gonna show you where I'm posting them so you can have access to those ones again. Okay, those gonna go to Blackboard. Let me find one Blackboard here, open. Should be somewhere open on my screen. And I'm gonna show you right away when I'm posting those ones. Oh, I forgot to tell you, did you get my email about that course evaluation?
Yes.
Yes.
Yes, please submit
Yes.
submit that course evaluation when you have a chance, please. They sent me something that says only 5 or 6 students submitted so far, or maybe a little bit more. So let me show you where I'm posting this one so you can see it and you can confirm that you actually see it. So we have here the first practice questions from April 7th. Let me keep everything consistent. So let me copy this name and I'm gonna change it to today's date. And let's add new section here, which will be document. I'm gonna make it visible for you. And I'm gonna upload this form file, which is gonna come from today. And the last thing that left is here to change this one to 14th. Save. And please confirm that if you have access to those practice questions from today.
Yeah.
Okay.
Have access.
Okay. So there's
Yeah.
a few more final exam practice questions. If you want to practice, if you have nothing else to do, you can practice those one too. But those are from the time that was given the paper exam. So if you find it useful, you may practice those one just for your knowledge, but mostly focus on those two sets of questions. Those will be similar to what you're gonna see on the exam. The last thing that left is the recording, and the recording from this from today is gonna be under recordings. Once you go on the recordings, I already posted that. Where was that? The final exam review, part 1, and today is going to be final exam review recording part 2 after this. So you're going to have access to the recordings, access to the questions, access to the exam starting on Thursday. So you have everything. Questions, guys? Any questions?
Nope.
No?
Not for now.
Not for now? Okay, if you have any questions, send me email. If you feel that you want to do something, that you miss some activities, and you still want to do those activities, let me know. Again, and the window here that you have will be till Friday, this Friday. So if you have to do some of the activity that you have missed, I'm going to give you a chance up to Friday. And that will be one thing. The other thing is I want to thank you for the semester. obviously you were not affected by the fact that I cannot walk. So for you, you're not suffering from that one. So yeah, again, thank you for the semester. There were a few of you here in this online lecture that helped me a lot in terms of being active, answering the questions. Always a few of you did that one, so you know who you are. And I really appreciate it's very, how can I say, it's very helpful for these online lectures when I'm talking to myself mostly, when I hear somebody and you give me that answers or say something that as a confirmation that you're there and you're listening and you're just telling me, hey, we are still here, keep going. It's very encouraging and it's very positive. I appreciate that positive energy that those of you who always participate during the lectures bringing to the lectures. Again, if that happen in the future, if you have those online lectures, please give from time to time. It's important, at least for me, it's important to know that you're there and you're listening, actively listening, and that's give me more encouragement and make me keep going. So again, thank you for the semester. A few more things that you have to do, and after that you can enjoy your very short break. Again, you can, I guess you can kind of make it longer with this course if you want to. And that will be it for me.
Thank you so much.
Thank you, guys. And again, some of you, we're never gonna see each other, probably ever. I don't. Some of you with those online, it's kind of tricky because we may not see each other at all during the whole semester. I know. So one of the previous online courses, one of the comment was he never turned on his camera, so we don't know how he looks like. That was kind of a funny comment. But again, since it's recording, if you want to see me, my room will be 4323. I won't be in the room by this semester, by the end of semester. I don't know how it's going to start in May. I may have to start May online, but somewhere mid-May, end of May, I'll be back in the college. So if you want to stop by, say hi. My room is open. My door is open. If you need any help in the future with the accounting or anything, again, my door is open. Thank you, guys, and enjoy everything that you're doing.
Thank you.
Thank you. Thank you.
Get well
Thank you.
soon.
Thank you, and hope your leg gets better.
Yeah, me too.
Same.
Thank you. Thank you.
Thank you.
Thank you.